Good evening, participants. Welcome to you all on today's webinar on the Masterclass series on the Companies Act 2013. So today's session is basically covering the topic on the Companies Act 2013, whereby we shall be covering and throwing light on the overview and the relevance for the chartered accountants. And also shall be focusing on the key threshold-based compliances under the Companies Act 2013, as well as we shall be covering the important topic that is the audit trail under the company's rules, under Company Rules 2013 Companies Act. Here we are having with us the Chairman of the Corporate Law Corporate Governance Committee, CA Dr. Devashish Mitra sir with us, and he is the Chairman of Expert Advisory Committee and a past President. And also we are having with us the Vice Chairperson of the CLCCG Committee, she is Priya Kumar ma'am with us, as well as she is the Chairperson of Sustainability Reporting Standard Boards. And also the eminent speaker with us, CA Dr. Chinnasamy Ganeshan sir. Yes. So with this, I would like to invite our Chairman sir to have a welcome address as well as the opening remark on the session and to take up the topic for the session.
Right.
Welcome, sir.
Thank you very much, Nisha Gupta, who is the secretary of our committee, that is the Corporate Law and Corporate Governance Committee. You see, I acknowledge the presence of the vice chairperson of this committee, Priya Kumar, and who is also a Central Council member. I have spent, from 2016 to 2019, we are together in the council. And now again, she has been re-elected in the past 2 years, more than 2 years we have been in the council. So total, about more than 5 years we have been in the council. She has been a past chairperson of this committee and doing excellently well. Now she looks after the sustainability reporting standards. And I believe, and from whatever I have saw her performing, she's doing very, very well. Mr. Ganeshan, you see, is a very eminent speaker, and I'm sure he will do justice to the topic assigned to him, that is the audit trail, which is such an important topic today. Let me first of all start speaking to you some words about corporate law and corporate governance. It has been, the committee has been in existence for concept time, more than 10 years. And over the period of time, the committee has performed and lived up to the expectation of the membership of the institute as well as other stakeholders. You'll be surprised to note, all the guidance note on Schedule 3, that's Division 1, Division 2, Division 3 of Schedule 3. All the guidance notes have been prepared by this committee, and which all of you have been using, to such good effect. Yesterday, we had a committee meeting, the 73rd meeting of the committee. We are approaching the 75th meeting, the 75th year of the institute. And yesterday, one issue came up, and that was relating to the disclosure of CSR expenses in the financial statements under Schedule 3. Please note that the guidance note that we had issued, there we had said that you have to give disclosure for cash expenses as well as the expenses which are accrued. But the question arose that the Schedule 3 does not talk about these disclosures. To what extent we can, to what extent these kind of disclosures are mandatory? It was discussed at length yesterday, and even the impact on Division 2 and Division 3, and we hope to give our opinion in the next few days. Yesterday also what we discussed was, the MSMED Act. Is that the requirements, whether the disclosure requirements as contained in the Act have also to be disclosed in the financial statements in addition to the disclosure requirements in Schedule 3. So that was also a very interesting discussion that took place yesterday. So CSR, that is, Section 135 of the Companies Act, when it was introduced in the initial stages, a lot of resistance. Over a period of time, it has now settled down. And you all are aware that certain classes of companies, even private companies, having net profit of 5 crores or above, are required to have a CSR spend of 2% of its average net profits of the past 3 years. So, CSR has stood the test of time. Now we have the penal provisions in Section 135. So, CSR is a very important aspect, and the disclosure requirements on CSR becomes very, very important. Audit trail, the subject of discussion today, is impacting Section 143. The institute has issued an implementation guide on audit trail. I'm sure Mr. Ganeshan will speak on that implementation guide. Um, we had issued an implementation guide in 2023. Then next we have come up with a list of FAQs in 2024. So those of us who are referring to the implementation guide, do refer to the implementation guide that has been issued by the Institute in 2024, which contains the FAQs, because the FAQs, as long as audit trail is concerned, is so important. And mind you, the reporting requirements, it's not only the companies which have to follow this audit trail provisions, but also the auditors and auditors of all companies. You see, that is, where the challenge is. So even those of us who are listening to me, and even if you are the auditor of a small company, you still have to report on audit trail applicability, and you still have to report on audit trail compliance. You see, edit log, that is so important as long as audit trail is concerned. What they're saying basically is this, that you cannot delete an entry at your wish. You want to delete, pass a rectification entry, right? And then when you pass the rectification entry, do write the time when you have rectified that entry, so that there's a trail about the rectifications that have been done. So see, this audit trail is a very important subject today, and I'm sure those of us who are attending today would find the discussions very interesting. Let me tell you, see, in the Companies Act 2013 was also introduced Section 144 to the Companies Act. That talked about the non-audit services, that is the banned areas. For example, you cannot do internal audit as well as statutory audit. You cannot do, accounts, you cannot write accounts and also carry out statutory audit. So many, the areas were banned in that. And what was also, they said that management services, you cannot do management services. Till today, the government has not really defined what exactly are the management services. I believe that in times to come, these definitions will come into play. On the 6th of June, those of us who are in Mumbai, this committee, along with the Women's Member Excellence Committee, is organizing a program on independent directors. We are having a very good response to the program. The program is being organized in our BKC premises in Mumbai. So we hope that the discussions there relating to independent directors as well as women directors, right? Because the Companies Act says, or the rule says, that certain categories of companies need to also appoint women directors, right? So for the women directors, for the independent directors, and mind you, the definition of independent directors was not there in the statute book before Companies Act 2013 came into play. Right. So because earlier it was only the clause 49 in the SEBI regulations, the LODR regulations, that you had that independent directors. Now we have in the Companies Act the definition of independent directors. And I'm sure, those of us, if you were in Bombay or anywhere else, if you attend that program on independent directors, you'll find that the program to be of great use. So do come and attend the programs. Fraud reporting. Section 143, subsection 12 of the Companies Act has become such an important section. And those of us who are a bit compliant with the forms, or who are a bit aware of the forms, ADT 4 has become such an important form as long as fraud reporting is concerned. And that is the only section 143, subsection 12 of the Companies Act where where reporting and the penal consequences are applicable not only to the statutory financial auditors, but also applicable to cost auditors as well as the secretarial auditors. And the penal consequences have been revised recently. They are a bit less severe, but please note, fraud reporting has become so important now, consequent to the Companies Act. And then we have also section 447 of the Companies Act, which defines what is a fraud. So that fraud area has become very important. So those of us who are attending this program, as we go ahead, we will discuss all these areas, all these issues, and the intricacies contained in these sections, because it's very important that we understand the intricacies contained in these sections. And when we are reporting as auditors, we report rightly, that we have a very good grasp over the Companies Act, right? The register's valuers provisions, they have been brought in. And today the Institute has developed the valuation standards. I believe there are about 10 of them, right? And then those valuation standards have also stood the test of time. And those of us who are registered valuers have to refer to those valuation standards. right? So you see, there's so many changes. The forensic standards, when we're talking about fraud, the forensic standards that the institute has developed, I believe that there will be 20 or 21 of them. So you see, those standards are also so very important. So as we go ahead, you see the changes, we have to note that the changes are numerous, and the changes, they impact the profession. And those of us who embrace the requirements contained in the Companies Act will do very well in the profession. And will do not only very well in the profession, will also provide value-added services to the stakeholders. So it is very important that we understand, and most importantly, enjoy the discussions that are taking place. I have been told that we are having a sizable audience today. And let me tell you, the Corporate Law and Corporate Governance Committee and the Institute of Chartered Accountants of India will do everything possible to ensure that you are updated and that you can provide professional services which are of a very high quality and high standard. With these words, I wish all of you a very happy learning, and thank once again Sri Priya Kumar for having taken the lead to organize this program. And I'm sure that Mr. Ganeshan will live up to your expectation and will enlighten you with his thoughts on audit trail. Once again, a very happy learning to all of you.
Thank you, sir. And it was a wonderful briefing on the general aspect of the companies which are relevant in today's scenarios that way. And now over to Shri Priya. Please take over the session forward.
Thank you very, very much. And on behalf of the Corporate Laws Committee and Dr. Debashish Mitra, the most respected past president of the Institute, I extend a very warm welcome to all of you to this webinar. This is a masterclass series where we're going to take out bits of the Companies Act, which are most relevant to chartered accountants, whether we are in practice or in industry. Of course, industry is a much larger gamut. So in fact, this was Dr. Devashish's idea that he said, instead of trying to do things which are non-thematic, why don't we stick to something that's thematic and take people over a journey? So for example, we find that there are very few chartered accountants in the M&A space. Just 1 minute, please wait. There are very few chartered accountants who practice in the M&A space. Actually, it's not very complicated. There is a structured series of steps that you do for an M&A, and the Companies Act actually makes it pretty simple. So it's these kind of topics that we would like to introduce in addition to the usual topics, which has a very close interface to our audit profession itself. And these sessions are as much for preparers as they are for assurers. And these sessions are as much for small and medium practitioners as they are for larger practitioners. So Thomas Friedman said, this is a flat world. And I'm sure Dr. Ganeshan will agree with me because, see, sometime back, I remember when I first started practice, I mean, I'm not too much into an assurance practice, but I used to be very scared to sign these Section 195 certificates because, you would not have the latest book. So you would not have the latest access to the latest DTA, etc. But today it's a truly flat world. Access to knowledge and resources is so high. That's on one part. In fact, I was talking to somebody else in the context of sustainability today, and he was mentioning how India is possibly the best positioned to enable all kinds of reporting because we are a very unique country with a digital stack. Everything is getting digitized. So it's in this context that this entire webinar sort of plays out for you. And Dr. Devashish spoke very well about the Companies Act, and I'm going to take the liberty of speaking for just another 5 minutes on this before I focus on the thresholds. So just like every other law, the Companies Act 2013 was a reactive legislation. Very few legislations in world history have been proactive, possibly the Manusmriti, Hammurabi's Code of Law. Every legislation has been reactive, and in the Indian context, it's also called as the 3S legislation, very famously called as the Satyam, Sharda, Sahara Act. Why? Because these three corporate failures very decisively determined how a new act would be written. And in that context, the Companies Act 2013 is a substantially differently motivated legislation as compared to the Companies Act 1956. And today, if you look at the journey of the world in the financial space, we have the first set of journeys for corporates where people only talked about sales. So, until, Sarbanes-Oxley broke out, I think the whole emphasis was on leaders who would sell for companies. And then after the crashes in the US happened, whether it was Anderson, etc., it moved to a different domain of very strong corporate governance. And it then flew into India as well. And a third segment that emerged, that's currently emerging, then there is a huge phase of digital transformation and risks associated with such digital transformations. The extensive pace of digitization. For example, the audit trails itself is a reaction to the digital space that companies operate in today. Incrementally, if you look at this, there's a new regulation that companies which maintain their books of accounts in electronic mode and are maintaining it abroad have to actually have them also located on servers in India on a daily basis. Now, of course, the last theme that I'm very personally also interested in from the ICI perspective is sustainability. From a time where risk and transformations dominated boardrooms, today you have sustainability themes which dominate boardrooms, and in that context would sort of implore each of you to actually participate in this sustainability journey in a professional context. India has about 6.5 crore MSMEs. All of them at some stage have to embrace this sustainability journey in terms of reporting their sustainability practices, their emissions, etc. Having said that, what are the top features about this Companies Act 2013? One, I think it provided for a one-place enshrinement. Whether you spoke about independent directors, whether you spoke about consolidated financial statements, in a lot of sense, it brought in other aspects into this. 143.12 fraud reporting, SFIO, special courts. The second thing I noticed about this legislation was that it was an act with teeth. Previously, the penalties used to be 500. Now it's 50,000. 185 penalty, I think, is 5 lakhs onwards. So here came a legislation which actually said, look, we don't just have a law, we want to enforce this law. The third important thing about this legislation, on which I'll speak a little more in detail for about 15 minutes, is thresholds. So Companies Act is basically a delegated legislation. What does that mean? It means that there is an act which is supplemented by a large body of rules. In exactly 338 places in this act, it says, and rules as it may be prescribed. This 338 was before the omissions of the liquidation provisions, but this is a rule-driven legislation that can be deepened or softened at will. So, for example, now when the Companies Act comes with a new rule on audit trail or a new rule on maintenance of books in India, then they only go and change the rule. So the government is able to react much, much faster. And if you look at the MCA website, the theme of MCA is actually empowering business and investor protection. So they want to actually empower business, but at the same time ensure investor protection. And the last thing that I think is most important about this act. So today, why did I specifically discuss this context of penalties? Because most of our clients are quite chill about it. They say, oh, Companies Act, fine. What's the big deal if I don't comply? The point is, you just tell them, why don't you try not complying? So that's where I think our role in sort of enabling clients to understand this act better becomes very, very important. And now with this extensive pace of digitization that MCA has undertaken, you find penalty notices for many, many cases sort of appearing very, very quickly. So it's important that our clients appreciate that they operate as a company, or even the preparers here or company officials here, that we operate as a company, then you have to comply with this act. See, India allows you to do business in any form. You can be a person, you can be a sole proprietorship, you can be a partnership, you can be an LLP, you can be an AOP, you can be a BOI, you can be a joint venture, you can be an unincorporated joint venture. But if today you choose to be a company, then the government is very clear that you will have to comply with and operate under the framework of this Companies Act 1956 and the rules that come. And the last part, which I will also lead on to my presentation, is this is perhaps one of the few threshold-driven legislations that we have come across. What does a threshold-driven legislation mean? It means that certain provisions of the Act will or will not apply depending on whether a company falls or does not fall into that particular threshold. A classic illustration is Section 135. It says 2% of the net profit, but only for companies which cross a 500 or 1,000 crore threshold or a net profit threshold of 5 crores. So in such a manner, there are several thresholds which have got attached to this act. We honestly wanted this to be an audit trail session predominantly today, but we felt maybe 2 hours would be long. So we said, let's embed 2 other themes. One theme being the overall context and overview of the Companies Act, and second, a threshold-driven legislation. What other aspects of the Companies Act are important? For the first time, this act spoke about KMPs. So watch out. If your clients need to have KMPs and they have breached the 10 crore paid up share capital threshold, then you'll need to have this. Internal audit. Some of these I'll be touching because they are the most prominent thresholds. There are very stringent guidelines on acceptance of deposits, Section 73 of the Companies Act. The Act for the first time provides for a dormant company, somebody who's not functioning in the normal course of business, but merely hold investments and have only some audit fee payout and filing fee payout. You can apply and keep yourself as a dormant company. The Act for the first time spoke about auditor rotation. It spoke about audit limits. Of course, the audit limits will come under the Companies Act which would come under ICI's mandated definition of how many companies you can audit. The Act for the first time spoke about women directors wanting diversity. The Companies Act speaks about women directors. SEBI speaks, the listed companies speak for women independent directors as well. The Act for the first time brought in registered valuation. Very important because several financial decisions are made based on valuations that are provided of assets. So in this context, of course, another thing that's interesting for the government is today whether all banks also, for valuation of their loans, appraisals, etc., should move to a registered valuation framework. I don't think that's yet happened as of now. There are far more stringent rules on insider trading, etc., which are even better covered in your LODR. The Act mandates spoke about 143.12, which Debashish ji had spoken about. The Act for the first time speaks about vigil mechanism, use of electronic mode for meetings, etc., and a whole lot more. But predominantly, the nice thing about this Act was also the introduction of thresholds. Now, in a separate context, how do you actually examine these thresholds? So imagine you have multiple buckets. The first bucket is the type of company: public, private, small, OPC, dormant, listed, etc. The second bucket contains what is the threshold: paid up share capital, turnover, outstanding loans, outstanding deposits, net profit in the case of Section 135. That's the second bucket. What's the third bucket? The third bucket is actually the values: 5 crore, 100 crores, 200 crores, 500 crores, 1,000 crores, 10 crores was another threshold. So you have value thresholds. Now, what the Companies Act says is which type of company, which parameter, which threshold. The fourth important thing to happen, to remember, the fourth bucket is, when is this threshold? I've largely seen two types of thresholds. One is as at the last balance sheet date. The second threshold being at any point in time during the year. So you have to be very careful. So what the Companies Act does basically is to create using these 4 buckets, a class of thresholds. And now I'd lead you on to my presentation, and Nisha can confirm if you're able to see it. It's not intended to be very long because I think it's more or less there in the Act, and I really don't want to eat into Dr. Ganeshan's time on a far more important topic. So we're
Yes,
going
ma'am.
to talk about thresholds, illustrations of thresholds, and how do you handle non-compliance. In fact, I will very briefly touch upon the non-compliance part, but I would also request Dr. Ganeshan to speak about it because, I'm sure this part was not covered in the formal introduction, but I think we do have an obligation to, mention this about Dr. Ganeshan. Dr. Chinnasamy Ganeshan is a practicing chartered accountant. He's worked with a spectrum of firms and hence comes with a very nice perspective of very good quality practices and the ability to apply it commensurately to an SME context. You'd find him on LinkedIn as well, and when I see his posts, I can see that there is a very strong commitment that comes to developing the SME segment and the emerging firms segment of the practice. Now, the second nice thing about Dr. Chinnasamy Ganeshan is every time I have a doubt, I call him. And he unfailingly clears my doubt. And I keep doing it all the time. And it's not just me, it's everybody. And I think he's truly been available for most of this fraternity. So coming back to thresholds, so I'd like Dr. Ganeshan to actually, if you can just slightly touch upon the NOCLAR, etc., because I'm not touching upon that, but it would be nice for us to learn. So the Companies Act establishes various thresholds for regulatory compliance and governance. And they're based on the company size, financial status, whatever we spoke about. Just remember those 4 buckets. And the applicability of the law is intended to be proportionate to the company's scale and resources. Now, in this threshold, I had only one it's a personal view. I felt somehow the thresholds could have been rationalized a little more so that we have lesser thresholds to operate. And the second interesting thing is, in fact, I missed saying this. This Companies Act looks at all companies. They started at least this way. They looked at all companies and painted them with the same brush. But over passage of time, they have actually gone back and liberalized several provisions. And these are subject matters for a separate day when we'll have a separate webinar on exemptions for private limited companies. What's very important for all of us is to look at these Section 464 notifications, which allow the government to exempt certain applicability of certain provisions of the Act to certain categories as they may consider fit and necessary. And in that context, I think you have Section 464 notifications for government companies. Very interesting in the context of dividends, etc., restrictions. Secondly, you have a 464 notification for private limited companies. I think there was one in 2015, which was further expanded to 2017. So ideally, it was too much to have in one session on the threshold, but those are also thresholds. Loans to directors, there's a threshold. Loans to directors' relatives, there's a threshold. Loans from directors, there's a threshold. Loans from directors' relatives, there's a threshold. Loans from shareholders, there's a threshold. All these are intended for investor protection. And these thresholds are basically intended to ensure that your regulatory requirements are appropriately scaled and fostering a balanced approach to corporate governance. And for those of you on this webinar who haven't guessed it by now, this is a paragraph from ChatGPT. So I just picked it up from the Google and I said, okay, let me have something embedded here. So, in essence, thresholds provide a structured framework that supports both business growth and corporate governance. So while I told you just a few minutes back, these thresholds could have been slightly lesser in number. The other interesting thing is we don't really define public interest entities. Ideally, certain provisions of the Act should apply only to public interest entities, and while certain others should not. But then today, India took a slightly different approach in this context. Because India is a very different country where you have a plethora of private limited companies. So and using this concept of public interest would have somehow put a lot of the big private companies also outside of this. What are the thresholds that we are quickly going to go through today? Small company. Now, this small company is very important. The present thresholds stand at 4 crores share capital and 40 crores of turnover. Does not include a public, a holding company, a subsidiary company, or a Section 8 company. Now, cash flow statements, there is an exemption here for one person, small, and a dormant company. Woman director, every listed company, every other public company. So if you're a preparer or if you're in the management of a public company or the auditor, here's something you might want to tell your client. Paid up share capital 100 crores or more, turnover 300 crores or more. Appointment of KMP, very, very important. See, in fact, touch upon handling non-compliance. Let's say you have a public limited company having a paid up share capital of 10 crores or more, or a private company. There is the requirement of a KMP to be appointed under Section 203 of the Companies Act. Now, suppose this is not done, and Dr. Ganeshan can add, how would you treat this in the auditor's report? See, a non-compliance with a law or a regulation may be material and pervasive. So some of these you will need to think through and see how you will present this in the auditor's report as well. And I think, in my opinion, KMP is one such that's very, very significant. Internal audit. So again, in internal audit, there's something very different. CARO requires internal audit for all companies where CARO is required to be complied with, which we'll come to shortly. So more than showing you the threshold, I wanted to present some insights on these thresholds. So CARO is more generic. It says internal audit commensurate with the business. More importantly, it says also speaks about how reports have been dealt with. So today, see, nobody writes a CARO for the sake of writing it, right? So I think it's not only important for us to ensure that there is an internal audit. It's not just a checkbox, but ensure that the internal audit reports are actually robust, because you are stating so in CARO. And today, when somebody says, have you reviewed the reports? If you find something not good about the report, please state so. I have in the past seen audit reports where they said internal audit can be strengthened, etc. So please feel free. In terms of internal auditor, they talk about all listed companies must have an internal auditor. Unlisted companies, the thresholds are 50 crores paid up share capital, 250 crores turnover, outstanding loans and borrowings. You remember I told you the fourth bucket. When is the threshold applicable? This is a classic case where it is at any point of time during the preceding financial year. Outstanding deposits, 25 crores. If it's a private company, 200 crores, outstanding loans or borrowings. See, I'm just trying to sort of open our eyes to the fact that these things exist and may have to be applied as appropriate. Exemption from ICOFA. There was a standard exemption, OPC, small company, private limited company. Turnover, 50 crores. Borrowings from banks, financial institutions, or any other body corporate, 25 crores. Now, what's really important is that thing that came below that particular notification. It says the companies above will be exempted from IFC only if they have not committed a default in filing their annual return under 137, under 92, and financial statements under 137. Now, again, there are two views here. I may have rectified the non-compliance, or I may not have rectified the non-compliance. There's no real official view on this. But I feel once you've filed it and you filed it with a penalty, you can continue to seek this exemption. Open to Dr. Ganeshan to speak about it. And this is just my understanding of the provision. Company audit ceiling limit. Of course, this I'm sure most of us are aware. What companies come under rotation? Just give me a minute. Yeah. This is the audit ceiling limit. I'm sorry. So here, it's a very interesting thing that came in the Act. The Act said 20 companies. Then the notification said small companies, OPC, dormant companies, and private limited companies with less than 100 crores paid up share capital shall be excluded. Which meant virtually there was no limit at all. But ICAI has stepped in, and then we have a limit which is prescribed by ICAI. Then we come to the question of applicability of rotation of auditors. Listed companies, public companies 10 crores, private companies 20 crores, all companies having paid up share capital below the thresholds and public deposits. CSR, you need to follow CSR and you need to have a committee as applicable. Every company having a net worth of 500 crores, turnover 1000 crores, net profit of 5 crores or more in an immediately preceding financial year shall contribute 2% of net profit computed in accordance with the Act. The average net profit of the last 3 years should comply with this provision. Audit committee. Listed company and public companies only are mandated to have audit committees under these thresholds. Paid up share capital 10 crores, turnover 100 crores, public company aggregate loans, deposits, borrowings or debentures exceeding 50 crores or more. Independent director, this we spoke about, and anyway, it's every listed company, public companies having 10 crores or more of share capital, paid up share capital. Please see that the reference here is paid up share capital and not net worth. That's a very important distinction to appreciate. Public companies having 100 crores or more, public companies which have an aggregate outstanding loans, debentures and deposits exceeding 50 crores or more. Caro, of course, Caro is something we are completely familiar with. There has always been one interesting question on Caro, the issue of small company and private company. So I think the institute has also clarified in the guidance note that this is the sequence in which you evaluate. If your entity is a small company, then they get exempted. And then you go through 1% small banking company, Section 8 companies, insurance companies, private limited companies with these thresholds of 10 crore, 1 crore, 1 crore of borrowings, or not being a holding or a subsidiary of a public company. So this was basically a short presentation. Now, how do you handle non-compliance? So today, let me take you off the slide. You have a non-compliance with a material penalty, and the penalty is being provided for in the financial statements. Then obviously the impact of that penalty is understood and it is provided for. That's one scenario where you have to take a decision. Second, a non-compliance, a material penalty, a non-compliance, a material penalty not provided for could impact your true and fair. Why? Because true and fair only talks about two things, right? One, that the financial statements on which you have provided your opinion are free from material misstatements. And two, that they are prepared in accordance with an applicable reporting framework, which is your AS and your Schedule 3. And very interestingly, AS is the fundamental and Schedule 3 is the additional. So whatever disclosures are required under AS also have to be provided for in the financial statements. Based on the assessment is above. So the point here is, some of these, in my view, for example, a KMP could be something that's material and not necessarily financial, because it talks about the intent of the government to have a basic governance framework. The second category, see today, there's a small penalty, let's say 30,000 rupees. The company is not provided for it. It's a non-compliance. In which case, I think you'll take a slightly different view on qualifying the financial statements or expressing an unmodified opinion. With this, I'd like to sort of close this. The views are mine. And by and large, these are all sort of aligned to the Act, the regulations, etc. So, but largely when we're talking about the context of the company, the only one thing that I want to place emphasis on is what I said the first. People have a right to practice their business or profession in any form. Should you choose to be a company, then one has to comply with the contours of the Act, and this is the message that we need to transmit. The only other thing that I keep very often seeing in various WhatsApp groups is, what do you do with as being auditor of a company which has no movement? I only have 20-25 crores of assets and 20-25 crores of liabilities. Essentially, a company which is dormant but not stated as such. I think a lot of safeguards have to be exercised in this context. So just imagine, why would somebody give you 20 crores loan and just be nothing, do nothing with it? Similarly, why would your client or you invest 20 crores somewhere else and not expect a dividend, not expect a valuation and a potential sellout, or not even receive an AGM notice? I think some of these contexts have to be closely examined, because a lot of money would have flown from other enterprises which could have a public interest involved. So possibly a holding company or some other related entity could have taken 400 crores and distributed to these various companies. The only other matter of emphasis I wanted to point out was in the context of strike-off companies. So today, even if you're looking at share capital, kindly ensure whether the company which holds the share capital in your entity that you're auditing, or whether even if you're a preparer, you're the part of the management, ensure that that company has not got struck off, because about 5 lakh companies have got struck off by MCA for non-compliance with the Act. I think it's very important. It's anyway covered in the Schedule 3 also on transactions with strike-off entities. So if any such thing is there. Similarly, if you have individual shareholders, I think people keep thinking share capital is so easy to audit. I will just put one tick here and one tick there. It's not. Share capital is a component that gets audited every year. Ensure that your shareholders are alive. That's also very, very important. So with these few words, I'd like to wrap up whatever I wanted to say. And it's over to Ganeshan sir for any additions, increments, corrections. He's the expert.
Thank you, ma'am. It was a wonderful session, ma'am, because many important crucial regulatory compliances and governance aspect has been discussed during the sessions. And it was wonderful from the way of point of view, the way you have discussed the various thresholds under the Companies Act is being governed and is given under the Companies Act in order to have a knowledge to the general, easily they can capture the important aspect under the Companies Act. Now, I would like to invite our eminent speaker of the today's webinar, see Dr. Chinnaswamy Ganeshan sir. Let me give you a brief introduction about this. Already ma'am has briefed about this, sir, but then also let me brief you a little bit more about him. Actually, sir has a more than 35-year experience, as already ma'am has said, in the area of auditing, and he specializes in financial reporting, company law matters, audit, taxation, and was conferred the honorary doctorate in his for extensive contribution to Ind AS and IFRS by renowned foreign universities, and is a recipient of the Jewel of India Award for his role in financial services and Certificate of Excellence for his contribution in the field of financial services. So that way we would like to just to get acquaint what is with our participants. The sir is going to share a wonderful knowledge with respect to the important aspect related to audit trail under the company's account rules. Welcome, sir.
Thank you. Thank you, Nick. Thank you, Madam Sripriya, as well as the Chairman, Dr. Devashish Mishra, for giving this excellent opportunity of meeting all the members on one of the important topic which we are going to discuss on today's thing is basically on the audit trial which we are going to discuss. One second, I think I kept 2 files open. So basically, when you are aware that there is a requirement for a reporting which has been modified as per the company's accounts rules 2014 relating to audit trial, the basic question which is coming to our mind is that whether this audit trial will pose a challenge for the auditors as well as the management. So what we are trying to look at is what is the requirement of the Companies Act based on the rules which has been amended, Rule 11G, and then what is the management responsibility, what is the auditor's responsibility, And what is the way in which the auditor can discharge their function as an auditor by carrying out audit of the audit trail, and based on that audit procedure, what conclusions they have to reach and how the reporting should be given in the audit opinion. These are all the major areas. There are some practical issues in every topic which we are going to discuss in respect of audit trail, right from whether you have to look at the audit trail on the database level, whether you are supposed to look at the audit trail at the application level, whether you have to talk about only the accounting software or the softwares which are working together for helping to record the accounting transactions. So a lot of practical issues are surrounding this particular topic. And the major issue which I have seen in my mind is that in case if the auditors have to qualify, because I believe that this reporting under audit trail in Rule 11G is a simple factual statement. It is not like expressing an opinion. Accordingly, normally people are believing that is it yes or no answer should be given whether the audit trail is existing or the audit trail is not existing. Whether the audit trail is existing throughout the period of the year or only for part of the year. Whether the audit trail is disabled at any point in time or not disabled at any point in time. So all these questions which the auditor is supposed to report at an audit trail is more of a factual information which the auditor has to give rather than doing an audit and using his judgment and based on which he has to give the information. To some extent, I can draw a parallel with the requirement of reporting companies, the auditor's report order, also, where we normally say that it's a statement of facts. And in that statement of facts also, because of the amendment which was made in 2020, there are areas where there could be a judgment which the auditor can exercise. For example, in one of the questions which they are asking, whether the company will be able to continue as a going concern or able to meet its liability as and when it arises based on the financial ratios, etc., auditor uses this judgment, right? Similarly, when the auditor is talking about or reporting on the fraud, the auditor is also taking a judgment whether this has to be considered as a fraud or suspected to be a fraud. So to some extent, there is auditor's judgment is also involved in CARE 2020. Accordingly, I believe the intention of law is not just a factual statement alone. And if the auditor can use his judgment in certain areas, he can actually add on to what he has observed. That is the way in which I'm looking the entire aspect of reporting of audit trail under Rule 11G. Let us look at what is the various aspects of this particular requirement. It's a new one, even though we were talking about this in 21, 22, now 23, 24. Maybe the lawmakers have also felt that there should be some time frame within which the entities should be ready for having the audit trail in respect of their accounting software. So this is a new provision in 3.1 of the Companies Accounts Rules 2014, and it has been added as part of 11G as a reporting requirement for the auditors. So this is, as of now, is applicable for financial year commencing on or after 1st April 2023, as you are aware, and accordingly for the year ending 31st March 2024, when you are issuing your audit opinion, naturally the audit trail facility which is existing or non-existing should be reported by the auditor according to this. So the first question which people are normally asking, maybe they have not gone into the implementation guidance issued by the WASB, where they have given an elaborate guidance on how to deal with the requirement of this particular rule and what is the way in which the auditor can maintain the documentation for the reporting and what should be the way in which they have to evaluate the management responsibility and the various software at the software level as well as the database level. So elaborate guidance is there. But unfortunately, maybe we are familiar with what we are doing earlier and what we wanted to carry it forward to the next year. I have seen certain fundamental questions arising in our mind. The first question which has been asked is this report of audit trial is a separate report or it's only a notes on accounts in the financial statement? When the second part of the question has come, I was a little shocked how the practitioners are serious about learning what is happening, even though the institute is taking proactive levels steps to ensure every practitioner, every management, every member in industry should be aware of what is the new development. Unfortunately, I have seen that one question came in one of the forum was, is it okay if I am giving a note in the notes and accounts and ask the management to include that particular note that the company is having an audit trial, and I get a management representation stating that the audit accounting software used is having the audit trial facility. This is a fundamental question which has been asked. For sake of clarity, I must tell you that this is a reporting requirement under section 143 subsection 3 because of the addition of rules 11G. To that extent, it comes on the main audit report relating to the law, legal and other compliances. For example, we have the format of the audit report as per SA 700, which splits the audit report into two parameters. One, a report on the financial statement and report on legal and other matters. Under legal and other matters, when we were discussing about CARO, we are discussing about internal control over financial reporting, we are discussing about 143 subsection 3 requirements of the Companies Act. Under 143 subsection 3, we should also report this requirement of audit trial on the face of the main audit report itself. Maybe the question to answer is whether the management can include a notes on accounts in the financial statement, because there are some misunderstanding. That is what my interpretation is, misunderstanding in the actual application of this requirement by many of the chartered accountants, because we are not yet very clearly knowing what is the audit trial and how the audit trial should be present. For example, the normal confusion starts with audit trial facility should be available at the database level also. But normally what happens is in a database level, the access to the database is not available for the users at all. The access to the database is available only to some super users, or maybe I can say that database administrators, and any change which they are making on the database, because it's a direct change in the database, normally get captured by means of an automatic trial. But only problem is there could not be an edit log. There may be a case of edit log being maintained or edit log is not being maintained. So people are having a feeling because of the interpretation which has been given at the database level also, the edit log should be available or the audit trial should be available. So in that particular scenario, there could be a possibility of management is having a different view, or there is some compensating controls, even though there is an audit trial which is not existing. So if the management wanted to explain that as part of the notes and accounts, it is their prerogative to explain, because the auditors cannot question why you are including a notes in the notes and accounts, because it's preparation and presentation of the financial statements is the management's responsibility. So they can include anything. If it is contrary to the auditor's observation, then there could be a possible dialogue between the auditor and the management to ensure that there is no difference of view or consensus has been reached with respect to availability or non-availability of the audit trial. So I believe that two things is possible because of this. One, on the audit report, the audit trial facility should be commented upon with the various requirement on the face of the audit report. Second is management is entitled to add A note in the notes and accounts, and the auditors cannot question why you are including that here, such a note. So now, whose responsibility is to maintain the audit trail? Is it the auditor's responsibility or it is a responsibility of the management? It goes without saying, because this audit trail is relating to the accounting software for maintenance of accounts, books of accounts. Naturally, auditors is actually coming at a later point in time to only verify whether the audit trail is existing or non-existing. And it is completely the responsibility of the management to use only those accounting software which has the facility of recording the audit trail. Okay, so it's a management responsibility prima facie, and auditor's responsibility is only to express an opinion on that. But having said that, what I have seen is that with this requirement which has changed, the audit procedures is increasing and the time is additionally has to be spent, and to some extent where the entity is using too many softwares, not only the accounting software, a lot of patches. For example, payroll is also there, inventory is also there, purchase is maintained separately. There is an EDA which has been used, electronic data interface, what I'm talking about EDA, is being used for CRM, customer relationship management, through which direct entries are coming to the accounting software. All these patches are also part of the accounting software according to this particular requirement. And it is not easy for the auditor just to look at only the basic accounting software, but he has to look at the various other software which is complementing the main accounting software. One possibility could be the auditor who is actually carrying out the audit of the financial statements under the Companies Act may not have the full capability of reviewing this facility also. For that purpose, maybe the involvement of experts within his team, an IT expert, may be required to be used for the purposes of evaluating the presence or non-presence of the audit trail is required. That means the cost will also go up, the audit procedure will also go up. So when I'm saying the cost of doing the audit goes up, it goes without saying that you should also negotiate whether there should be a fee increase for the current period and on a go forward basis as well. But normally we believe that everything should be given as a one single bundle, and accordingly whatever new amendment comes in, we should actually help the client. Unfortunately, you will end up with having a lot of time to be spent, and to that extent you should also adequately rewarded for the efforts which you are carrying out. That is one word of suggestion which I am giving to you. Now, what is new if I am talking about this is the requirement under the rule. What the rule says, I'm actually using that on or after April 1, 2023, but the rule was actually started with 21 and then 22. Then by means of a notification, it has been changed to 23. So I'm just using the 23 straight away. If you look at the actual rule, it may not be 23, right? But the effective date is only April 1, 2023. For the financial year commencing on or after 1st April 2023, every company which uses an accounting software for maintaining its books of account shall use only such accounting software which has a feature of recording audit trail, blah, 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 it goes on, right? Now, what are all the requirements? If we say that this is the requirement, let us understand this by splitting this particular requirement into various specific requirements. The first thing is, it talks about, of course, financial year commencing on or after 1st April 2023. Naturally, if the financial year is calendar year for the purposes of reporting to consolidation for other companies, 1st January 2023 may be the current year of accounts for certain companies, because there is an option available to get a specific approval from MCA, and you can do that. in case if you're a subsidiary or associate or joint venture of a foreign company which follows the calendar year. In that particular case, for them it is applicable only from 1/1 to 2024 because it talks about financial year commencing on or after 1st April 2023. And again, there are another questions which may normally come to our mind is that 31st March 2023 or before that, audit has not been completed for certain reasons. Maybe there is a dispute or there is some issues. Because of that, the audit could not be completed, and the audit is being completed subsequent to April 1, 2023. Whether the audit trail should be available for those previous periods also. My answer is very simple. Because it's a financial year commencing on or after April 1, 2023, the reporting date is not the criteria. The date on which the financial year commences is the criteria. So that is on the first part of the date on which it is applicable. Second is it uses the word every company. When I say every company, there is no separate exemption available for any company. In other words, I can say, even if it's a small company, the threshold limit which the vice chairman was actually talking about under various sections, including what the small company is and what the exemptions available for small company. Those exemptions are not extended for this audit trial, even if it is a small company, even if it is a 1% company, even if it is a Section 8 company, that company should use an accounting software which has the facility. That means every company it is applicable, no exemption. And that company should use the accounting software for maintaining books of accounts. Now the question is, what is maintaining books of accounts? Because this is one argument normally comes to our mind, is that when the books of accounts means it is a software which is used for the purposes of maintaining the day book, ledger, trial balance, or maybe the subsidiary ledgers, and nothing to do with anything relating to inventory, anything relating to fixed assets, anything relating to my inventory management or any other aspects, including payroll, etc. But unfortunately, anything which we are talking about as a software, the evaluation which we have to do is that whether this software is being used for a direct posting in the books of accounts. For example, you maintain a payroll software separately, and from the payroll software, you are extracting the month-end entries to be passed. And that entry has been passed manually by means of a journal as of the month end or the beginning of the month end, whatever you call, based on the method of book closure for MIS purposes which the company may be having. In that particular case, when you are entering transaction, including payroll, into the books of accounts in the accounting software alone, my way of looking at that is the payroll software is not part of the accounting software because it's not for maintaining books of accounts. It's only to maintain my payroll. From the payroll, I extract the data and pass the journal entry for recording my salary, etc. So it's not an accounting software. On the other side, majority of the cases, what we have seen is the payroll software directly interconnects with the accounting software and passes the summary entries by means of journal directly. Or I can say that through a patch, it normally passes those entries because we don't want it to manually enter again the data. Automatically, we are pushing the data into that. In that particular case, the payroll software will also be considered as an accounting software for maintenance of books of accounts. This is the easiest example which I can tell you. What are all the things which you can consider? Similar to that is inventory management. If the inventory issues, receipts, etc. is maintained by the inventory module of the accounting software and direct entries for consumption is coming into the accounting software, then the inventory management module will also be part of the accounting software for maintenance of books of accounts. That's the way in which you have to interpret it. There could be another scenario where there are two different softwares which is being used. One is an accounting software for maintaining books of accounts, and another software for entirely different purposes. But we use a patch for taking the data or downloading the data from that particular software and pushing it to this software. In that case, the patch which you are using for pushing the software, the entry into the accounting software, should also be part of the accounting software. That is the way in which you have to interpret and you have to analyze. And accordingly, it is not just enough to look only at the accounting software. Maybe I can give an example. In a NBFC, the loan management system may be a separate software, but from the loan management system, whatever amounts collected, whatever amounts which has to be appropriated between interest, income, for other activities, or maybe adjustment towards the principal, is directly being pushed into the accounting software. The loan management system is also considered as a software to be tested for audit trial. So I have seen a lot of cases where the auditors have taken a view that the HR management software, HRBS or HRMS, whatever you call, is not having the audit trial, and accordingly they have mentioned that specifically in the audit report as well. So that is what I wanted to tell you, that when they are saying using an accounting software, what is an accounting software? The auditor should have a bucket list to validate, or I should be, when I'm using the bucket list, everything should be part of that, or otherwise a complete list of the various software the entity is using and how they are working together with the accounting software. Is it a direct entry or it is a separate module, based on which the auditor should look at the coverage of various softwares for the purposes of checking whether they have the audit trial. What this software should have is audit trial of each and every transaction. And I'm saying each and every transaction, you will understand that there is no exceptions given for journal entries pushed as a management for MIS purposes, automatically reversed in the subsequent period, because these are all the things which an ERP system or a SAP system or any other accounting software, or maybe the practice which the management uses. Year-end accrual month-end accrual will be done as an MIS entry, and immediately it will be reversed on the first automatically. Even the automatic journal entries are considered as a transaction to be covered here, because it is recorded in the books of accounts, right? So audit trial of each and every transaction. What is audit trial? We'll see in subsequent slides, but for your understanding, if you see this, it talks about edit log of each change. That means when the entry has been originally originated or recorded, subsequent to that, any change made in the original entry, there should be a log, or there should be a record of the changes made. The record of changes is actually called the edit log, and that is normally maintained in the system and in the background. You will not normally look at the edit log, but it's available in the background for every change which has been made. In other words, a transaction originally recorded, if it's being modified at any point in time, modification includes even deletion or changing the dates or changing the amount, changing even the narration, etc. Whatever has been done subsequent to recording the transaction, you must be able to see what is the changes made, what is the reason why. Reason, of course, you cannot find it out by means of edit log, because system just captures that date on which the change has been made, what was the original transaction, what is the modified transaction. This edit log, which we are talking about, I have seen one specific issue is that when we were saying that the edit log of each change made, if I have made one change, first original record, then it has been modified. Again, I am going and changing the same data. Then the modified transaction is again underwent a modification, right? Each change has to be captured. If I'm changing one particular entry 10 times, 10 times should be captured. But unfortunately, in many of the transactions, the original entry will be maintained and the subsequent the last modification which has been made will be maintained. Is it a sufficient edit log of each change? To my mind, you can accept that for a simple reason. What was original transaction is already available in the edit log, and what is the subsequent modification, last modification, because the last modification is impacting your financial statement. You will be able to understand whether there is any specific reason why that change has been made. So you can compare the reason, you can compare the impact on the financial statement, etc., etc. So to my mind, even if the software is not capable of managing or maintaining all the changes, 10 times if the changes have been made, all the 10 changes has been recorded, not relevant. You can simply take a view that it maintains an edit log. So original entry is available and the last entry is available also is enough. It's to my mind. That is my view. And what the requirement, if you see, such an edit log should not be disabled at any point in time. The reason is very simple. If I wanted to record the edit history, the edit audit trial facility should be enabled. There are cases which I have seen. In fact, in one of the discussion, it came very strongly from the users that if I am enabling this particular audit trial facility, the time required to process data is actually goes up. When I am processing millions of lines of transactions, it takes a lot of time to take the actual report for the purpose of my analysis, for the purpose of my MIS, for the purpose of reporting to the board. They actually come out with an industry related issues also. For example, in one of the bank, they have talked about it. In one of the NBFC, they have talked about it. And one of the company which is using third-party software as a service has said that this is an industry issue. So we don't have a solution for that. But unfortunately, the way in which this guidance note is looking at, or the way in which it is drafted in 11G, Rule 11G, it is only expecting the auditor to say whether it is existing or not existing. And to that extent, the auditors are feeling that the hands are tied and they cannot even accommodate the request of the client beyond a particular point in time. But I normally have one feeling, even though it is an yes or no, we can use our judgment to add the reason for not being enabled if the client is giving. Or maybe you have a compensated control or compensating controls to ensure that even if it is not there, you can able to check that in another aspect. In this software, it is not enabled, but another software is actually giving you edit log of whatever transaction you are making, even in that particular module. I believe that you should go with the positive note that edit log is available, because it's only talking about an edit log. Every module, whether I have to have an edit log, it's not that. The accounting software which I use has an edit log facility. So if one module is not having the edit log, but whatever is required to check whether the entries made in that particular module has been continuously monitored by means of another module where the edit log is fully available for all the transactions, each and every transaction, then I believe that the edit log facility or the audit trial is existing. But what is my experience with the other auditors, or the way in which the other auditors are looking in some cases, is that since there is no practical guidance available except the guidance note existing as at that point in time, it is also not fully matured. We are not having an experience of this. Maybe it will get matured over a period of time, maybe 1 or 2 years. The first year, majority of the accounts will have some sort of specific point saying that it is not enabled, it is not available for a particular year, a particular period, etc., could be possible. When I'm saying that this audit software should have the facility of audit trial for each and every transaction, creating an edit log of each change made in the books of accounts, along with the date when such changes were made, and ensuring that the audit trail cannot be disabled. So this is the requirement of law. Accordingly, the responsibility of the management is to ensure that the edit log or the audit trail is available to monitor each and every change made in respect of each and every transaction. Okay. Now, there are some frequently asked questions. To my mind, whatever comes to me as my doubt, I'm just putting that into the framework so that any further questions other than this also we can have after the end of the session. First question is, if I have a customized software, which is an ERP, SAP, or in-house developed software, in an ERP or SAP, normally a transaction log will be there present. And in a customized way in which ERP or SAP is implemented, there could be a possibility that the edit log is a flag and that flag is not opened. So you are not enabled that edit log. Could be a possibility of a situation where you are, even though it is available, you are not enabled it. Because it is not enabled, you are not able to get the report. So in that case, there could be a possibility of qualification or except for which will be coming in by the auditors. So in a normal customized software and in-house developed software, my feeling is wherever customization has happened, there could be a possibility of the audit trail is not being properly enabled. So you have to take your view based on the list of software which the entity is using when you are getting it, classify them. Is it a standard software, or it is a customized software, or it is in-house developed? And if so, who is having the controls for any modification? And if that controls for modification is available, how the modification is captured by means of edit log is one important aspect which you have to look at. There are some off-the-shelf packages like Tally, Zogo, QuickBooks, type of softwares or packages which are being used for maintaining the accounts. I've seen cases where entity uses a separate customized software for the entire activity, but for accounting purposes, they use Tally. So in that case, they are using a patch to push the entry or not using the patch for pushing the entry is an additional consideration. If they are using a patch to push the entry from the other software to Tally, then the other software patch and Tally has to be looked into as one single for the purpose of audit trail under Rule 11G. And I've also seen in Zogo, it's like an ERP package, so there is a automatic edit log facility available. QuickBooks is also similar to that. In Tally, what I have understood is that Tally has come out with an edit log facility, even though it was already available in the original version itself. They called it as a Tally Vault, in which whatever changes you are making, that will be recorded in the vault, and the super users can identify what are all the changes which has been made. If that facility is still enabled, you can identify what are all the changes which you have made. That can be a possible way of looking at as an audit trail facility. And in some cases, where the versions are changing, if you are not enabled it properly, that could be a challenge. And what my understanding is, Tally has come out with a version where they can incorporate the audit trail by means of a small patch. Automatically, when you are using that particular patch to update it, the software maintains all the changes, including, I have seen that including what is the transaction originally recorded and what is the modified transaction. What is the transaction originally recorded and when it is deleted? What is the transaction which has been incorporated on a backdated entry? It maintains all the records. So the requirement for all of us, because I have seen that in many cases our clients could be small and medium companies, maybe using only Tally as the accounting software, whether that has to be brought in with respect of this particular requirement as well. We have to educate them. But the problem is, if they are going to do it only now, for the previous period, there could be a challenge. We will see what is the reporting requirement arising out of it. The next question comes is, I don't own the software. I am using the software as a service. That means I pay only license fees. Because of that, it's a cloud-based where I am able to access and do that. And accordingly, database level, no audit trail may be available. Or transaction level, I may be able to see what is the audit trail. In this case also, because of the requirement is not only at the transaction level or the application level, but also on the database level, there is a requirement for the auditors to look it in a different perspective. Because it's a software as a service, what I have seen in my experience is that this type of organization, when you are using the work of another service organization, there is a standards on auditing, which requires how you have to deal with the internal controls with respect to that and how the auditor has to evaluate. The same way you also evaluate how they maintain the transaction changes at the database level. Normally, the database level changes are not allowed to the user who is paying only the subscription or license. It will be maintained by the software developer. That is a company which is providing the service. They will be maintaining. And there, they will be having a stringent process of recording any changes which is coming in the software, database level, direct access, etc. will be recorded. So you have to look at, in that case, I normally suggest that you get a certificate from the service provider and provide that certificate to the auditors for their comfort that at the database level also it is there. I have already mentioned about the software patches for different activities. Interesting point is where this audit trail is not at all required is if the books of accounts are manually maintained, ruled out, because no entity, even if the smallest trader, is now using an accounting software right from billing stage to accounting transaction. And to that extent, the manual books of accounts is only hypothetical situation that you will get a comfort. Real comfort is not available on this. Suppose partially it's computerized and partially manual. For example, if you are maintaining your FA register in Excel spreadsheet, I normally consider that as a manual register. In the manual register, how you are maintaining that, how you are modifying it, also what is required to be monitored is what my personal view. And what is the audit trail? As I have mentioned already, it is edit log to trace back to the original input made and what is the present transaction so that visible audit trail evidence is available. It's a chronological record of changes made. This is where I have the problem. Chronological record of changes made means all the changes made should have been recorded. But unfortunately, in some cases, the last change might have been recorded. It might be overwritten. Still, I believe that it's enough because the last transaction is affecting your financial statement. If you are creating a new data, for example, management override of controls is one of the aspects which we have to consider during the course of our financial statement audit. So for managing certain numbers, all of a sudden they are putting one entry on the backdated basis by means of insertion of new data, then that should also be captured in the edit log. Updation, modification, change, alteration, whatever name you call of the existing data should also be covered. If you are deleting the existing data, that should also be covered. That is what it's an audit trail. There should be record of what has happened to the original input to the present situation. When we look at the requirement of audit trail and audit log may be a series of logs. It may not be only one. It may be many audit logs. Put together is called the audit trail. That's what I was mentioning. If the log is maintained for inventory separately and your your sales transaction separately, your payroll separately, each will be giving an audit log. All put together is what I am considering as an audit trail under this particular rule. Okay. So now, What can be traced using an edit log? You know pretty well. Tracking of backdated entries, deleted entries, modified entries, cash balance changes which might have been made, etc. Could be the possible way. Change of inventory, valuation, any other changes. Any other changes which you have made should also be able to be traced by means of the presence of audit trail. Now, what is the responsibility of the management? Because this is very important, because it comes under the Companies Act. Management is responsible, and if you have seen the requirement of the rule, it says every company should use such a software. That means company's responsibility is to use such accounting software which has the audit trail facility. So that means the responsibility is every company which uses an accounting software for maintaining books of account should use, may use, will use, or can use is not there. It very, very clear mandatory requirement. Should use only, should is also there, only is also there. Mandatorily should use such accounting software which has the following feature. What are all the following features? One, it is not only talking about audit trail, it says records the audit trail for each and every transaction which we have seen, creating an edit log for each change made in the books of accounts, along with the data on which such changes are made. So that means the modifications happen for each and every transaction from the original input to the input which is presented for the audit. There should be a very clear way of looking at the audit trail, or the changes made should be very clearly visible. That's the way in which the accounting software should maintain a record of the changes made. The record of changes made is, we call it as an edit log. Collective of all the edit logs is, we call it as an audit trail. And the next responsibility for the management is also that such an audit trail facility is not disabled at any point during the year. Say, for example, I wanted to do certain entries. It is very easy for me to go and disable the audit trail facility so that it doesn't and it's not disabled at any point in time. Any disablement which has been done by the management should also be recorded as by means of an edit log. That is what very, very important. That is an area where the auditors are concerned, especially at the database level, whether the edit logs is available to maintain the audit trail. Simply somebody is changing the audit trail facility being disabled, it is possible for making any changes on that. So this is the responsibility of the management. And interestingly, the penalty for non-compliance is very, very stringent. So the managing director in charge of finance, chief financial officer, or any other person identified by the board for the purposes of financial reporting, all considered as officers in default. The fine for non-compliance will be a minimum of 50,000 to a maximum of 5 lakh per person. Except there could be a possibility of huge penalty being levied by the Ministry of Corporate Affairs at a later point in time. But at the same time, the intention is not the stakeholders, but to create an environment in which all the controls are put in place. And accordingly, maybe in the first year, when they have not understood it properly, it will be a lenient view which they may take. I'm using the word may take. So still the possibility of a penalty may not be avoided in certain cases. Okay, we have talked about management responsibility. We talk about audit log, audit trail, edit log, etc., etc. What is the auditor's reporting required? Why I was talking about too much relating to the edit log, not disabled, etc., etc. What is the requirement? 11G is actually bringing you to report on the main balance sheet under section 143 subsection 3. after the dividend related disclosure which you are reporting which you are making, the next reporting will be relating to your audit trail. Here again, I have used financial years commencing on or after April 1, 2023 for easy understanding without any confusion, but original was 2021. Now effective date is 2023. Whether the company, in respect of the financial year commencing on or after 1st April 2023 has used, their management is supposed to use only such software, whereas here we are saying whether they have used such accounting software for maintaining books of account, which has a feature of recording the audit trail facility, and the same has been operated throughout the year. All transactions recorded in the software, and the audit trail facility has not been tampered with, and the audit trail has been preserved by the company as per the statutory requirements for record retention. Management responsibility versus the auditor's reporting requirement, you may find certain small changes, but has a big impact. For example, when you are saying using only such accounting software which has an audit trail, both are similar. The same has been operated throughout the year for all transactions. Is auditor has to respond. Whereas if you see the management responsibility, for each and every transaction, it is being maintained. Supposing I'm just assuming from the management side, I have maintained that only on 31st March it was available. But for the auditor's reporting requirement is throughout the year for all the transactions. That means the auditors has to look at when the audit trail facility has been enabled, whether it is disabled at any point in time or it is operational only for a part of the year. All those things the auditor has to look at, and based on which his reporting requirement will also get modified. For example, you are seeing that after you have given an awareness to the client has incorporated the audit trail facility. Say for example from October 2023, then you have to say the audit trail facility in respect of so and so module has been enabled from 1st of October 2023 to 31st March 2024. So it is clearly communicating it was not existing up to September, but only for the next period it is there. In other words, because you have a reporting requirement throughout the year for all the transaction, it is not existing. You have to actually make that particular statement in your audit opinion. This is a small change, but requires a lot of work to be done. The audit trail feature has not been tampered with. They are also, their management responsibilities is not disabled. That means intentionally they are not going and changing the audit trail feature. Here also we are saying the same thing. So nothing to worry too much on this. And the last aspect is audit trail has been preserved by the company as per statutory requirements for record retention. Actually, it talks about 8 years from the year on which the records have been maintained. So if I'm talking about April 2023, from April 2023, 8 years they have to maintain. And accordingly, the guidance note says that for the first year, it is applicable only from the current year. And accordingly, there is no question of auditors responding to the last part of the discussion, or maybe the audit trail has been preserved as per statutory requirements is applicable only from the next year, that is 25 March. Not for 24 March reporting requirement. It is not applicable, is what the guidance note suggests. You can take two views, because 1/4/2023 to 31st March 2023 should also be maintained as per the statutory requirement. So from 1/4/2023 itself, the clock started ticking. You can retain the same language. That is one aspect which I have my own view on this. Or you can also say that reporting of this is not applicable for the current year. It is applicable only for the subsequent year. You can have your reporting accordingly. That is left to your choice. So what you are going to report? The entity has used such accounting software for maintaining books. Feature of recording audit trail facility is existing. That is operated throughout the year for all the transactions. That has not been tampered with. The audit trail has been preserved by the company. as per the statutory requirement. The last two is, according to the guidance note, is applicable only from the next year. And anyway, you can take your view whether you wanted to report in the normal scenario as well. Okay. But majority of the audit opinions, they are saying that it is applicable only from the next year onwards. Okay. Having said that, what are the audit procedures I have to follow? Because when I am supposed to report in my audit opinion, I should have planned the nature, timing, extent of the audit procedure, performed the audit procedure, identify the exceptions, evaluate the exceptions, and based on which I have to reach the conclusion. This is a chronological order in which from start to end, any audit procedure or any audit of a transaction or any audit of a balance will be done. Similar to that, when you are doing an audit of existence or non-existence of the audit trail, you should also know what are all the activities which you are supposed to do. I believe that the first requirement is to identify the records and transactions that constitute books of accounts. I have explained enough number of times what you mean by books of accounts. Is it only an accounting books, or your inventory records also books of accounts? Your FA register is also books of accounts. Your subsidiary ledgers are also books of accounts. Your payroll system is also books of accounts. So you have to first identify what are all the records and transactions that results in the books of accounts, or which creates the report as books of accounts for you to audit and you to validate the transactions and the balances at the end of the period. So you have to first take a complete list. The completeness of this, how you can ensure you, because I don't know how many accounting software or how many patches or how many additional softwares they are using. I don't know. Naturally, I should first ask the management to list out what are all the various softwares used for maintaining the books of accounts. I have to get the list from the management, and then it is not just getting a list from the management and say this is what client has given, so I have validated. You are having a requirement to validate the list given by the client. It's nothing but corroborate the information provided with the actual data. If anything is missed out, to ensure completeness of the entire software, patches, additional modules which you have to cover, to list out that this is the accounting software which is used for maintaining the books of accounts. Okay, so that is the reason why we are talking about the software, the IT environment, including applications, web portal, databases, interfaces, any other IT component used for processing or storing of data, for creation, maintenance of books of accounts. So that is the reason why I started talking about that in a simple manner. It is not only one accounting software. You have to look at what are all the things which are going to help you out to ensure maintenance of books of accounts. So including web portals and databases, when I'm saying cloud-based accounting, when you're doing, that is also part of that. Only aspect when respect of cloud-based accounting is we may not have the control and we have to get it from the provider of software as a service. And again, the third one is validate whether it maintains edit log and whether audit trial feature at any point in time has been disabled at the database level, or it is available even at the application level and database level. And this audit trial facility is appropriately protected from any modification. Because if I just say edit log is available, but the edit log can be edited, then there is no question of we talking about an audit trial at all, right? So accordingly, the audit trial should be appropriately protected, whether it is the controls over any modifications towards the audit trial is also possible. Because normally the audit trial will be maintained by means of text files. In the text file, I can go and edit by means of using any software, right? So accordingly, any changes which I am making in the audit trial also, or the edit log also, it should be capable of being captured. Then maintenance and monitoring of audit trail are designed and operating effectively throughout the period of the reporting. You have to validate from which date that edit log is available, from which date the edit log is not available. There are possibility that the edit logs are overwritten on a daily basis. If it is overwritten on a daily basis, the last date edit logs may be available, the others might have been erased. In that case, what I have to do practically? I have to necessarily look for this facility. It's a factual statement. Edit log is available, but the edit log could not be verified fully for throughout the year because it's overwritten. By the system default, it's being overwritten and nobody is manually doing it. System itself is doing it. Is there any archive of this transaction is kept elsewhere by the system? You inquire. That is the way in which I am saying that it's not enough for the auditor alone to do it. Maybe the IT team of the audit firm should also be involved to do a little bit of extra work on this aspect. If the archive is available, you can see whether the archive is containing the transactions which has been erased for the last date, but it's maintained separately. And what are all the compensating controls which are available to manage edit log? I have already given one example that edit log for a particular module may not be fully available here, but there is another edit log which complements that what you wanted to see, whether any modification made is maintained in another module, that can also be used as an edit log. So you have to evaluate on a holistic basis, not having a stringent consideration that this is not available in that particular module. Okay, then we are assessing the identification of records and transactions where audit reports or audit trails need to be captured and do a test basis of checking whether it is being properly recorded. In fact, one of my friends has actually asked me, is it possible to take a screenshot of the audit trail for each of the month and keep that as an audit documentation? And is it enough for me? Because the audit trail facility is already available. So I have told him that yes, that could be an audit evidence that there is a transaction log available. But at the same time, if there are some modification which has been made or deletion which has been made or a new entry has been edited or inserted, do you have an additional audit procedure for checking the appropriateness of that modification? Because this requirement, the guidance note also makes it very, very clear. If the edit log facility is not there, that doesn't mean that the entire financial statement should be qualified. So one is 143.3 and the other one is whether the fair presentation of the financial statement, it does not contain material misstatement. That's a next question automatically comes in. When we are looking at that particular aspect of material misstatement, I have told my friend that you can take the list of the edit log month on month and keep it as your audit evidence, but do a validation of the reason, root cause for the edit which has been made and whether it has any impact on the financial statement. If it has an impact on the financial statement, you have to evaluate them as a normal financial statement audit as well. One transaction has been modified, why it is modified? Whether it's a genuine correction of your entry or it is intentional change of a particular data for the purpose of reporting a different number in the financial statement. You have to evaluate. And what is the implication on your main audit report on financial statement also you have to look at. Controls to ensure that user IDs are assigned to each individuals and user IDs are not shared. And of course, it will always fail. That is my experience even when I was doing an information systems audit. I have seen that user IDs are shared and they are using it. Even the supervisor user ID is also being shared with some people. And accordingly, this particular aspect, when you are checking, if the controls are very good, you can be very, very comfortable that edit logs can be relied upon. Otherwise, it may be a little difficult for you to do a substantive procedure to ensure that all the aspects are there. Perform audit procedure to ensure changes to the configuration of the audit trail are authorized and logs of such changes are also maintained and viewed. So when we say audit trail facility is not tampered with, tampering is intentional. So there could be a possible reason why the audit trail has to be modified. But whatever modification has been made is also captured and the edit log is being maintained, then that is a full proof that you have an audit trail right from the origin to the end of the transaction. And of course, you will also look at the backups, restoration of backups, access logs to ensure that the audit logs or audit trail is not tampered with at any point in time. Okay, so that's the audit procedure which I was looking for. With the audit procedure I have performed, what could be the likely scenarios which may emerge is management may maintain adequate audit trail as required by the accounts rules. Management may not have identified all records and transactions for which audit trail should be maintained. That means only for part of the year or not for all the modules. It might have only maintained for the main accounting software. That could be a possibility. The third is not enabled throughout the accounting period, even in the accounting software which they are maintaining. These are all the possible scenarios based on which your reporting comes in. Before that, let us look for whether the reporting of audit trail is applicable only for separate financial statement or standalone financial statement, or also applicable to consolidated financial statement. This consolidated financial statement is also a reporting under the Companies Act, and to that extent, it is applicable to CFS as well. So what is the issue which may come as a practical issue is you will be relying on the work performed by the component auditors. If you are not the auditor for all the subsidiaries, associate and joint ventures, you must make a reference about that particular aspect also in your reporting on audit trail. You have relied on the work of the other auditors, and since SA 600 is not made mandatory in Indian scenario, you can still rely on the work and straight away use it in your audit report. Globally, it is different scenario. You have to take the complete ownership even for the consolidated financial statement. And if there is any component auditor who are missed out and that results in a material misstatement, you will be held responsible for it. So that fortunately, it is not the requirement in India. You can trust the capabilities, expertise of a fellow chartered accountant for the purpose of doing it. One more question which may be coming in respect of the CFS is, suppose I have a foreign subsidiary which was incorporated under another country's laws, whether the audit trail should be existing even for that particular subsidiary. Here we have to step back and see this requirement of audit trail is made as a requirement of the Indian Companies Act. Globally, there is no such requirement. Even under US GAAP, it is not there. US PCOB, it is not. PCAOB, it is not there. The UK also, it is not there. FRC, it's not talking about. Other countries, regulators are also not talking about. We have made this as a requirement under law. And accordingly, if the company is not incorporated under the Indian Companies Act, they are not bound to maintain the audit trail. Having said that, when you are reporting the CFS, you have to specifically point out that in respect of so-and-so subsidiaries which were incorporated outside India, there is no mandatory requirement to maintain audit trail, and accordingly, those auditors are not reported. And to that extent, we are also not commenting on the existence of an audit trail. You have to mention that in CFS. Naturally, CFS has a different ball game when we are talking about standalone financial statements. Whether additions, deletions made in the entries automatically results in audit qualification. That means what I'm trying to say is that if you have identified that there are edits which has been made or deletions which has been made, and you can see from the audit log whether that will automatically result in an audit qualification on the financial statements. Materially misstated, fair presentation is affected, etc. The answer is no. You have to evaluate whether that has any impact on the financial statement. And as you know, when you are evaluating the audit modification, you have to go with the SA 705. And to that extent, whether it is material, whether it is pervasive, All those aspects you have to evaluate, then only the modification is required. Otherwise, it may be a genuine modification also, it doesn't, one possibility. And another modification which has been made, even if it is intentional, individually or in aggregate, it's not material to the financial statement and it's not fraudulent. Okay. In those scenarios, you can actually evaluate and do your main audit report accordingly. When I'm saying intentional modification, if you are having a feeling, then automatically another requirement for reporting under CARO 143 subsection 12, whether you have a fraud or suspected fraud. In that case, there is a reporting requirement to the central government. If the amount goes beyond 1 crore or if it is less than 1 crore to the board. So you have to evaluate that also. It is not simply looking at the audit trail aspect alone. What is the implication on your main audit report? What is the implication on intentional changes? Whether it has to be evaluated as per SA 240 on fraud risk in the audit of independent auditors report, as well as the CARO reporting requirement. What happens if the company is recording the transaction only at the year end in one go or using a part-time accountant? This, I have specifically taken this for a simple reason. There are cases where the entity may be a very small entity and they are not having a regular accountant who will be making all the entries on a contemporaneous basis. They may be recording all the transactions at the year end using a accounting software, or they may be given this to a part-time accountant who was making the entries in one go. Whether that will be considered as part of non-existence of audit trail, the point is completely different. Whether you are passing an entry in one go or you are using a part-time accountant, audit trail is to record that these transactions have been passed on a retrospective basis. If it is maintained, 11G is complied with. But you have to evaluate whether this recording is having any impact on the financial statement is an audit perspective. That's the way in which you have to look at it. Whether passing of audit JVs will have any impact on the audit trail reporting. Because 31st March is over and you are doing the audit to say, for example, in May or June or July, and you are suggesting an audit entry and that is getting captured in the audit trail, whether that means it is something incorrect, we have to look at. To my mind, audit JVs will happen only after the year end, and to that extent, it doesn't have any impact. But the audit trail facility captures the audit JVs which have been passed as part of the edit log, then I am fine. What are all the reporting requirements in case of correction of a mistake? Say, for example, if there are some errors in the previously recorded entry, instead of passing a rectification journal, they have gone and modified that particular transaction. Your edit log captures the original transaction and also the modified transaction. In that particular situation, what is the reporting requirement? There are two reporting requirements which I have already mentioned. One is 11G related reporting requirement, where the modification is getting captured in the edit log. That means you are complied with that particular requirement. You can give a clean sheet on that. The second aspect is you have to necessarily evaluate whether these modifications is only for correcting a mistake, why that mistake has happened, whether the appropriate of the modification is correct or not. You have to necessarily evaluate for your financial statement audit. Okay. Whether audit trail should be maintained only for transaction or for master data, my view and as well as the guidance note is saying for master data also, if there is an edit which has been made, that should also be looked into. That is what we are looking up. There could be possible scenarios where the client comes out and says that the data has been corrupted, there is cyber attacks, the all data has been recreated to maintain the books of accounts on a full-fledged basis. And because of the data corrupted or cyber attack, I am not able to provide you the full audit trail, etc. In all these scenarios, we have to look at what is the auditor's reporting requirement. It's a factual reporting, so give the factual reporting on that. Also evaluate whether you have to add any emphasis of matter in the regular audit report. Can I rely the work of the ISA auditors? Definitely you can rely on the work of an ISA auditor, but of course you have to use the requirement of using the work of an expert whether you have documented it properly. Can I simply rely on the management representation and issue my audit opinion stating that I do not possess the required technical knowledge because I'm not an IT auditor? Can I issue that report? My feeling is it cannot be possible. In fact, I normally go and use a very strong statement. Sometimes my colleagues will say that you are very aggressive on using that statement. I normally believe that the management representation letter is not worth the paper in which it is printed, because there you can get the management representation letter is very clearly mentioned in the standards on auditing. Beyond that, a management representation letter cannot cure an audit deficiency. So the specimen I have given only for the specimen without any modification. And here I have stopped with the aspect, do not come across any instance of audit feature. I have not talked about the other aspect, whether it is maintained for the period for which it is supposed to be there. This is a management representation letter which you can collect from them, but evaluate the management letter with the corresponding corroborative evidence to ensure that. And of course, your audit report compliance or the reporting requirements goes with the SAS 700, 705, and 706, and accordingly, you have to evaluate whether the disclosure is required, whether the evidence is required has been properly maintained or not maintained. That's the way in which you are supposed to look at it. That brings me to the end of the session. If there are any questions, I will just look at that questions. I think that it's in the chat box. I will try to answer. Can it be popped up in the screen itself for the benefit of others, or I will read it?
So you can read it, but I just request your kind.
What should be done? Okay, what should be done and how? I will first close the presentation. I will share the presentation to the committee so that the committee can circulate to all the members. So I'm stopping the thing and then going with the questions.
Sir, I seek a bit of your time, sir.
Yeah.
Sir, I have to just get into another meeting. So I
no issues. No issues, ma'am.
Yes, sir. Just a
please go ahead. Please go ahead.
It was a very, very nice. Very nice.
We were overrun by 5 minutes. Maybe I will take few questions and close it.
Yes, sir. No problem. Thank you so much for this wonderful presentation. In fact, what we would like to tell the auditors is that if you look at at least one big listed company which I have seen, they have very, very specifically spoken both about the non-maintenance of the books of a connected entity in a server in India. And they've also clearly said an entity connected to this entity has maintained audit trail only for a part of the year. So it's happened with the case of a listed company, a big auditor. I think that's a lot of courage for us, even the smaller auditors, to say, yes, if this is the fact, we must put it out. So thank you so much, Ganesh.
Thank you. Thank you, ma'am, for the opportunity. Thank you. Bye. So I will take the questions one by one. What should be done and how the audit report should be prepared if a private limited company maintains manual accounts and audit trail is not available? Just put that because the company is maintaining books of accounts manually, the provisions of Rule 11G is not applicable. You just make that statement in the main audit report itself, because if you are not explaining your opinion on 11G, even if it is not applicable, sometimes there could be a possibility of the reviewers coming back and asking that why that is not reported. So better to say, because they are maintaining books of accounts manually, audit trail is not required under Rule 11G. That is the way in which you can report. How to qualify the audit report in case audit trail is not available in the case of government companies not maintaining accounts in computer-based accounting softwares like Tally, ERP, etc. My feeling is, even in government companies, they are maintaining books of accounts only in accounting software. Nobody is now maintaining manually. So accordingly, every PSUs or every company, government companies which you are auditing, you should evaluate the availability of the audit trail. If the audit trail is not available, the guidance note very clearly mentioned some specimen modified audit opinion. For example, audit trail facility is not enabled. They simply make the audit trail facility is not enabled in the accounting software used for maintenance of the books of accounts. If the audit trail has been enabled only for part of the period, they are also mentioning the qualification. which has been given in the specimen, is that the audit report facility, the edit log facility or the audit trail facility has been enabled only for the period from so and so to so and so. They are making it very clear. The third possibility could be the audit trail facility is not enabled for all the modules which are complementing the accounting software. In that particular case, you can mention that the audit trail facility is not enabled in respect of so and so module, maybe for full period or for part of the period. And the fourth possibility is database level. There could be possibility of no audit trail existing. In that case, database level controls audit log also should be maintained, because direct entry should not be made by users of the accounting software. So if it is not available at the database level, you have to appropriately make it. But at the same time, if the database level controls are being maintained by the database administrator, especially when software as a service, you can get a report, a type 2 report, or whatever SRE report which you are talking about, take it from them and use it as the basis for saying that controls are existing, because you cannot go and validate at the service provider's system, because they may not allow it, because every auditor of the service availing entities are coming to their entity. They will not be able to find time to do their activity. That is the reason why the audit procedures globally has been enabled in such a manner that they can get a specific audit to be done, including the facility of this. In fact, in one of the client case, we got a specific certification from them that they have the record, and which we have taken on a record, and then we have completed that work. That you can actually do. If a company gives a rent-free accommodation to a group company, whether the same is required to be reported in the director's report or auditor's report, of course, it is not relating to the audit trail, but rent-free accommodation to a group company B, I'm not sure whether group company B is a related party transaction will get covered. If that transaction has been taken into consideration and it has been approved by the board and the shareholders, because it's not an arm's length transaction, section 188 and the related requirement of the Companies Act has to be taken into consideration. Okay, Sripriya, to take my questions. So Sripriya has asked to answer her session also. Not a problem, ma'am, I will take care. Caro applicability, one private company which is covered in small company but having paid up capital and reserves up to 2 crore, whether Caro is applicable. This is an interesting debate normally we have, because the way in which small companies have been defined, and for private limited companies there is another exemption based on some threshold limit which has been given. Shipriya has dealt with that. What is the conclusion we have is very simple. If you are considered as a small company, automatically you are getting the exemption. You need not even go to the next level of threshold limit, even if you are getting there as a private limited company. So small company is automatically exempted. So you need not worry about it. Please make a nice brochure with web link to the record. Okay. And that is Sripriya's guidance to the committee. In case the payroll record is maintained separately and manual journal entry is passed, why are you not considering it as a software for maintaining books of accounts? The figures which comes through this software is affecting the financials, right? Even if the manual entries are passed, why are not considering in accounting software related recovering trial? Very simple logic. The correctness of the entry passed in the books of accounts, as an auditor, I will validate. So whatever is coming from the payroll records, definitely I will validate as part of my audit of financial statement. But whether that entry is passed manually, I need not go to verify the edit logs at all. Because when I am doing a financial statement audit, I normally look at who are all the employees, what is their master data relating to the basic salary, etc., etc. I will also validate month-on-month salary paid, whether there is any big variation, and month-on-month average salary per employee, whether there is any big variation. I will also validate the correctness of PF in the ESI accounted, All these aspects I will definitely validate as part of the financial statement audit. When they have passed a journal entry, I will go back to the journal entry as part of my financial statement audit. I need not worry about audit trial with respect to that separate module. That's the reason why I mentioned that. How to report if entity enabled the audit trial appropriately, but during the year their hard disk is crashed. I have already explained that it's a factual enablement, factual statement which you have to make. Whatever they have mentioned and whatever you have corroborated with the actual fact. If they are simply saying my entire data is corrupted, you have to also get some audit evidence that what they are explaining is acceptable to you or not. On that basis, you can give a factual data. Because the data has been crashed, we are not able to verify the existence of the audit trial throughout the period. Maybe it is crashed only for a particular period and they could recreate only for a balanced period. You can also mention that particular aspect because it's a factual reporting and not a judgmental reporting. So you can mention the fact actually. Small company which does not have turnover or having very small turnover and maintaining accounts without audit trail, then how to be reported and what is the penal provision? Unfortunately, they are not differentiated between small company, very, very small company, micro company, all those things they are not evaluated because the very purpose for which this section has come, if my understanding is correct, that it is the requirement of CBIC. So for income tax purposes, they wanted to ensure they have brought in as part of the requirement under the Companies Act. So whether the penal provision could be non-compliance with the provisions of 11G under the Companies Act. In respect of the income tax, there could be a possible different view taken by the department, saying that since you don't have an edit log facility, to that extent, whether your books of accounts are reliable or you have done anything wrong is not verifiable. To that extent, the assessing officer may go to a very, very long step of saying that your books of accounts may be rejected and I will pass a best judgment assessment. Hopefully, in the first 1 or 2 years, they will not have that harsh decision, but the possibility is not ruled out. Do we have to qualify the report if the audit trial become operational after 1/4/2023? It is not a qualification. The wordings which has been given is except for. So you can, it may be considered as an audit qualification. That's the reason why notes on accounts I have said it should be used. And then I have also mentioned that it should be responded by the director's report also. Whether changes made to software should also be logged. Yes, change management is also coming as the application level. So it should also be recorded. If audit trail is not maintained in part or whole of the year, will it have to be result in qualification by the auditor? Straight away, I have said that it's not qualification on the financial statement, but you have to specifically make the statement in 11G related disclosure. If third party is maintaining books of accounts, certificate of the third party is acceptable. I have already mentioned, yes, it is possible. Who should issue that certificate is the other party who is an authorized person who can issue the certificate. If there is no edit log facility enabled, do we need to qualify our report? Yes, you have to qualify. Do you not think the audit trial is mainly related to information technology? Why not government should put IT system audit report in this respect instead of putting the burden on statutory auditors? Auditors are not well versed with the software. ICA should represent this matter to ministry. I'm fully aware of this question, but at the same time wanted to tell you that we are in the digital era. All the transactions are being recorded using a software. If our audit tools are not able to validate the application level controls and transaction level controls, general IT controls, we are not able to discharge our responsibility as an auditor in a proper manner. That is the reason why there is a specific standards on auditing in an IT environment, where the books of accounts are being maintained by the IT environment. So necessarily, you should also have, either you should have possessed the technology or you should have an IT expert in your team. That is what every company is, every audit firm is now having. And so you cannot avoid by saying that I'm not well versed. Okay, that's all the questions which I am having as of now. Now I pass it on to Nisha for a formal closure or for any other question which we are having.
Thank you, sir. Thank you, sir. It was a nice cakewalk through the audit trail, and it was a wonderful session. And I suppose, and I hope, in fact, our participants also enjoyed and drive the benefit out of this webinar. And sir, with this, would like to close because every query has also been sorted out. And
Okay.
that bit was a wonderful session. And thank you, sir. Thanks a lot.
Thank you
To
very
our
much.
chairman,
Thank you.
sir, vice chairperson, and to our eminent speakers. Thank you. Thank you very much, sir. It's just information for our this. Members, those who have completed the webinar, their unstructured CPRs will be uploaded within 7 to 10 days time, and the PPTs will be shared with them. With this, we would like to end the session. Thank you. Thank you to all.